So
Yeah, I think you bring up a good point because that kind of swings to the other half, or I should say the equal half of investment real estate. Let's talk about who's in your building because you're
yeah,
absolutely right. I think actually oftentimes, especially with very, very long tenured leases, you might have somewhere in there an option to buy at
yeah,
some point in time. But the property is the property. The tenants are really the lifeblood
sure.
of a lot of the analysis because brick and mortar valuations, I mean, those are what they are. We all know, generally speaking about that. But here it gets a little unique. It gets a little
Yeah.
gray in some areas. And here we're talking about tenants.
Yeah, so I
D- d-
mean, the better the tenant, the longer the leases, the easier it is to get financing for. It's really as simple as that. If you've got a lot of
yeah,
like
pretty much.
mom and pop shops in there, nail salons, things that are not multiple location, don't have corporate guarantees associated with them, things like that, there is a view that those are more risky, more likely to
Hmm.
deteriorate than if you have Starbucks and Verizon and all
Right.
these national tenants that have like locations all over the place. And on a lot of times, those big companies will have a guarantee from the corporate entity guaranteeing the leases.
Right.
And so in those cases, the bank and the owner and whatnot, they all feel comfortable that they're going to get paid. And so
Right.
a lot of time, and so what they do is a lot of times those companies also having sign longer leases. They'll sign a 10-year lease where,
Hmm.
maybe a nail salon.
I've seen 30-year leases
Yeah.
for supermarkets. That's not uncommon.
Yeah, exactly. And so what's happening then is the bank is generally wants to lend to you for their term is not going to be longer than the average of the
Correct.
leases. So
Yeah.
if the average lease length is 3.5 years, 4 years, most banks are not going to want to lend past that. But if the
Right.
average length of the lease is 15 years, then you've got a lot more flexibility. It's
Right.
easier. It's easier to lend and get a longer term on that. And the
Ev-
amortization is different, but the term will
that's
still
different.
will
Yeah.
be associated with kind of the average leases.
Right. We're going to tie the maturity to our sort of longest standing repayment source, right? So, I mean,
Sure.
every deal I've worked on, literally the first question I ask is for a detailed rent roll, right?
Yep.
So, which tenant is in which space? When did they start their lease? When does their option terminate? What happens after they terminate? Most times you'll see a lease terminate and it goes right to month to month.
Yeah.
That can be a scary proposition because they can pull the plug at any time.
Yeah.
So tenant strength really becomes a really critical part of the analysis. Just like when we're talking on the commercial side from lending, when we're analyzing the business for a repayment source, here the tenants are the repayment source. So what
Yep.
we typically do, and just banks in general, when they look, is they see at what tipping point does vacancy make the deal not work? Because honest to God, I've seen deals where it's a strip mall. Strip malls are very popular in investment real estate. It's one of the ones you get the most. If you have I've had a deal where there's one pinnacle tenant, I believe a supermarket. Don't quote me on that, but it was a supermarket. They had been in there for 30 years. They're not going anywhere. The analysis is just predicated really on that lease. If any other tenants come and go, that's excess income.
Fine,
But
yeah.
we had only always run our analysis on, is the supermarket still there? It is. We're good to go.
Yeah.
Because, I mean, now granted, they also monopolized 75% of the strip mall. So obviously they're paying really, 75% of all the leases and rents going in there. But so long as they're there, we would tie our deal to that.
Yeah.
And even though that lease had ended at one particular time, and then after that lease was over, it was on a year to year. Now, typically when you go month to month, year to year, it does at times, it can make a financial institution a little bit more uncomfortable, uneasy. But this is a strong pinnacle tenant that had been in there for 35 years. They're clearly,
Sure.
not going anywhere at this point in time. It's an institution. So,
Yeah.
those are the types of things that really go into who's in the building, what type of business is it. I mean, this is 2021. A restaurant in a strip mall is not an ideal tenant. They might
Well,
have a signed lease through the end of the year, but they might not make it to the end of
Sure.
the year.
Another thing that's really important on those kind of anchor tenants is, if you've got a really strong anchor tenant, it helps to kind of lease out the additional spaces. And then that's why they're called those anchor tenants, is because
Right.
they're bringing in other businesses. And, if you've got a really well-known supermarket, or you've got a Walmart or a Target or whatever it is, that all those other like empty spots around, they're all going to get filled out because people want to capitalize off the traffic that's being brought to them
Right.
by the Target, by those large companies, and so that helps the deal as well. But so the quality of the tenant is very important. I've worked on a lot of single tenant deals where, they're corporate guaranteed leases, and the bank loved it. They're like, okay, well, we know
Right.
this is a publicly traded company with AAA rated credit. We don't have a problem. We know we're going to get paid for it. So it makes it much easier to lend to those.
It does, and there's one other facet. So we talked about tenants now as well. One thing that's important to note with tenants, and a bank will look at this relative to the market, is are your rents above or below market? The market dictates, depending on your area code, geography, what type of, businesses they are. There's certain rents at certain levels that, are considered market rents. This is what
Sure.
this type of square footage and this geography mandates. So if you're above market rents, obviously that's better. The market says you charge whatever $40 a square foot, you're charging 45. That's better. But really, when the market dictates you should be at 40 and you're 30, that takes into question, well, why are you offering somebody
Yeah.
below market rents? And that happens for a number of different reasons. One, maybe that's how you could secure a super long-term lease. Two, and you'll see this a lot with, corporately backed leases, they're going to argue a lease for 30, 35 years, but they're going to do so to their benefit as well.
Sure.
If the market says 40, we'll sign 30 years, but you got to give us, 35, 30, maybe $25 per square foot, below market lease. So it's a give and take.
Yeah, and
if you're going to have these shorter term tenants, a bank doesn't want to see kind of a one-off mom and pop shop getting a below market rent, because then that signals you're really struggling to find tenants. You're just going to take the first offer, the first guy that comes in and wants to lease your space. That's not a good sign from an investment in real estate.
And not to go too much off on a tangent, but what I also have seen in this particular space, talking about tenants and whatnot, is I've seen a lot of investors come in, and what they'll do is they'll kind of get a property that has some vacancies or has lower grade tenants, and all they'll do is they'll come in, lease up all the space because they're able to buy it at a lower rate because they don't have as strong of rents, as strong of values. They come in, lease it up, better tenants, and then sell it. And they turn around and sell it. Now you're selling it with stronger tenants with longer leases, and the values are perceived to be way higher. So
Right.
so we see a lot of that as well. One more thing before we get off the tenants that I want to talk about, which I guess it kind of goes into the type of property as well, is depending on the tenant, sometimes they're doing something that can affect the property in a negative way, whether it be environmental or whatnot. Like if you have a tenant in there that's
Right.
doing some kind of chemical thing or whatever, that
Paint shop, something like that.
all those kind of things can cause problems, and so that could derail a deal a little bit. So, if you're looking at a deal, even though they have like a strong tenant, if they're doing something in the property that could damage the property or cause some kind of liability issue,
Right.
that could be something that could be a little bit of a problem. You're right.
Right. And that's all going to come out when we do our environmental due diligence, which, just like flood, you're going to do your flood due diligence, see what kind of floodplain it's in, if it is in one, which could be a deal killer. You're also going to do a due diligence, and the bank really just doesn't at times want to take that risk because, not only is there something to remediate, but, who's paying all those remediation charges? It's hard to repurpose a space for sale when an incoming tenant has to come forth with X amount of leasehold improvements just to fix an issue that wasn't theirs. So yeah, it becomes a real issue. And then obviously environmentally being the other focus is you got to make sure you're doing it's not going to be of hindrance and you get into some litigation for years and you don't have the money to float that.
Yeah, I mean, I have seen the opposite happen as well. Like, so I have had like some clients that were leasing out these properties to industrial companies, and they'll put in like these huge cranes in their warehouses and all kinds of other improvements, redo all the driveways, redo like all kinds of fencing and stuff, and it really increases the property value.
Right.
But those tenants are planning on being there for 10 or 15 years, and they just kind of think of that's part of the cost of doing business in this particular facility. But when the guy goes out to release the property, now there's been all these improvements. It makes it way better. So, sometimes if you get a good tenant in there, it can really help the value, and especially if you were looking at selling it, because a lot of times people, they get, like I said, they get those good tenants in there, and then they sell the business and, sell the building and make some money.